Hi there, welcome to Kneppy Invest. Continuing on my theme of looking at financial year 22 results for numerous companies on the ASX, hopefully I'll be continuing on this series for the next few months. One of the things I really like about doing this series is I am focusing on a lot of companies that I know nothing about. That is definitely true for the company I'll be featuring in today's video, HiTech Group. I have not looked at this company in the past, and I am not sure why, because when you look at the chart, it's an absolutely beautiful looking chart over the past 10 years. And when you look at the revenue growth over the past 10 years, it is absolutely stunning as well. Not only that, this company is small, still has a market cap of about $80 million. It is profitable and it is growing profits as well. Maybe the reason I haven't had a look or closer look at this company in the past is just simply what they do. So this company specializes in ICT, which ICT stands for Information Communications Technology, contracting, consulting, and recruitment. And really, recruitment and consulting is not that attractive to me. But even though it's not that attractive to me, this company has been doing a wonderful job over the past 10 years. So it probably needs a closer look. So I've started the process of having a closer look at this company, and doing this video is that first step. I do have quite a few videos lined up in this series, and the next 5 companies I'll be doing a video on looking at financial year 22 results include SEEK, Index, which will be my next video, GUD Holdings, Fiducian Financial Services, and BHP. If you have any recommendations on a company that you'd like me to look at in this particular series, and I do prefer those companies to be profitable, growing revenue, cash flow positive, those sort of companies, just leave those suggestions in the comment section of this video and I'll see what I'm able to do. Now onto the quality of HiTech Group, and this is the first step I usually take or make when I am researching a company, particularly if it's the first time I am researching a company. I usually make this assertion or this decision fairly quickly when I look at the revenue growth, when I look at the chart. So those are the first two things I look at, and just based off those two things, you probably have to say this company is more high quality than low quality, and you'll see what I mean when we look at those two things. But there are some other things I do look at as well. Margins, gross margins I have a look at. So I want to see gross margins at least remaining steady or even growing through time. When I look at what the company does, whether there's any moat or competitive advantage. So when I combine everything together, I'm really undecided on a HiTech Group right now. So I'd probably say it's not a really high quality company on the ASX, but I wouldn't call it a low quality company either. Even though it is small cap, about $80 million market cap, this company is profitable and they are growing the revenue, and the share price looks absolutely stunning, or the chart looks absolutely stunning right now. So I'd probably put HiTech Group sort of in between high quality and low quality. So what this means is I'd be interested in the value of this company, and also the share price action, and the chart will be also important. So I'll be focusing on both of those during the rest of this video. Also have a look at their financial year 22 results. And this is HiTech Group's chart over the past 10 years, looking at the weekly chart. And this is exactly what you want to see if you've been holding a company for the past 10 years. Now, there was a bit of a breakout in HiTech Group back in 2015. You saw massive volume over about a 3 to 4 month period, and the share price increased from around about 5 cents all the way to a high of around about 60 cents. So that's the time to get in. And then we saw the pullback, but the share price has been increasing ever since then. So even if you compare the share price at the peak in 2015, which was around 60 cents, to now, we are seeing the share price triple since then, because the share price right now is at $1.90. But if you look at the last 2 years or so, just under 2 years, the share price of this company has been going sideways. In fact, the top of the share price was about $2.40, and that was back in around about September of 2021. So right now, share price is going sideways, even though the share price or the uptrend is still intact. Share price is not moving down. When you look at the weekly chart, I wouldn't find any rush or have the need to rush in and buy any shares in this company right now. So I think it is prudent to be patient in these sort of situations, particularly when the overall market is on the downswing. when we're in a bit of a bear market. So this point in time, just looking at the chart, it looks beautiful over the past 10 years. But recently, and we'll have a look at the daily chart later in the video, recently the share price is going sideways, no upwards or downwards action at all. Now onto the financial year 22 results for the company. And before we have a look at revenue, profit and operating cash flow, first have a look at the valuation. So not a lot of shares on issue. So at a share price of $1.90, the market cap of this company is 80 million. Now, one of the issues with this company is the illiquidity of shares traded. So today I'm recording this video about 1 p.m. East Australian Daylight Time, not East Australian Daylight Saving Time. So trading has about 2 hours to go, and not one single share has been traded on this company today. That's not an issue for me, but it can be an issue for fund managers and institutions like that. And the best way for a share price to rise over time, or over a long period of time, is for fund managers to get interested in the company, and increasing amount of fund managers. Eventually they will, if HiTech can continue to grow their company. You will see fund managers become interested in this company, and we'll eventually see the liquidity improve. So for the very fact that this company is liquidly traded is not a concern for me. In fact, I own quite a few companies that might not have a single share traded today. But anyway, share price at $1.90, or the market cap at $1.90 is $80 million, which doesn't seem excessively high when you look at the revenue, $63 million, profit $4.4 million, and operating cash flow minus the leases $7.5 million. And revenue, profit, and operating cash flow have all been increasing over the past 10 years. And the earnings per share, 10.73 cents. So just comparing the earnings per share to the share price, or you can just compare the profit to the market, we automatically see the P/E ratio of this company is less than 20. One of the ways I judge whether a company is high quality or low quality is just look at the revenue growth over the past 10 years. And really from 2014 to now, the revenue of this company has been growing at a really good, consistent rate, increasing from $8 million to $63 million. We saw a massive jump in revenue from 2021 to 2022, increasing from 42 million to 63 million. Not sure if that is sustainable. But if we do calculate the compound annual growth rate in revenue over the past 10, 5, and 3 years, we get numbers in excess of 15% per year. So over the past 10 years, 18.8%, 5 years, 17.5%, in last 3 years, 24.5%. And that increase in the growth of revenue has been helped by that increase in revenue in the past year. Now, one of the most concerning things here about this company, and I've showed you the gross margins in this particular chart, is that gross margins have been dropping over the past 7 years. So if you go back to 2015 and 16, gross margins were about 21%, and now they're down to 14.8%. I would like that to start going up, or at least start going sideways. So that is the one concern I have around HiTech Group right now, is that decreasing margins, gross margins. That is telling me some of their profit or some of the revenue they're bringing in, so that increasing revenue, some of that revenue is lower quality revenue than they had back in 2015 and 16. And maybe that's the reason why they're getting more revenue, is they are allowing more of the lower quality revenue coming in through the door. When I say lower quality revenue, I'm meaning lower gross margin revenue. Now into the financial statements, and the first financial statement we're going to look at is statement of cash flows. I'm going to ignore the balance sheet and the profit loss statement, and then I'll have a look at note 27, which is the reconciliation of profit to operating cash flow, because there is something I want to explore here when I look at the cash flow statement. So the first thing I always look at is receipts to customers. We already know revenue is growing, and it shouldn't be a shock to see receipts grow from $42.7 million to $70 million in financial year 22. And just like revenue, that has been impressive growth. But when you look at the operating cash flow, we have seen that grow considerably from last year, up from 2.9 million to 7.5 million. So that's an impressive growth. And that actually does have me interested in this company. So $7.5 million of operating cash flow. And this company doesn't spend a lot of money in investing activities, only $59,000. And if you take away the dividends paid, $4 million, this company is generating a lot of cash, so a lot of free cash flow. So $4 million in dividends paid, and the growth in cash was quite impressive as well. So even though they paid $4 million in dividends, cash on hand actually increased from 6.6 million to over $10 million. So this company is improving their cash on hand, which gives the company and the management a little bit more flexibility moving forward. So one of the most important decisions management of a company have to make is what they do with the cash generated in their operations. So do they give that money back as dividends? Well, the company is already doing that. Possible share buyback if the company thinks shares are undervalued. Acquisitions, this company could make some acquisitions. So a lot of decisions the company of this or the management of this company have to make what to do with that $10 million. Maybe they're happy to have $10 million of cash on hand. Maybe they're happy to increase their dividends to pay a little bit more of this cash to their shareholders. So those are some of the decisions that the management of this company have to make over the next year or so. When I look at the cash flow statement for HiTech Group, the first thing I realize and want to understand is why there is a difference between the profit, which was $4.4 million, and the operating cash flow, which was $7.5 million. That is a big difference, a $3 million difference. And for a company like HiTech Group with a profit of $4.4 million, I want to understand why. And fortunately, the company does explain why in note 27, which is the reconciliation of profit after income tax to net cash inflow. Usually the reason why there might be a difference between profit and operating cash flow could be because of depreciation and amortization, particularly if a company is capital intensive. That's probably not true for this company. Or there's going to be some significant changes in working capital, and that is true for HiTech Group, particularly in regards to receivables. In fact, there was a decrease of $2.1 million in receivables, which means if there's a decrease in receivables, that is a cash or should be treated as a cash inflow. And the way I look at this, if you do see a significant changes in working capital like that, that means that operating cash flow of $7.5 million is not quite as impressive as it seems on first glance. And the profit of $4.4 million is a better representation of how this company is performing. And then I go back to the dividend point. So this company paid about $4 million back to the shareholders in dividends, and that is nearly 100% of their profits gained in the business. So this company is paying most of their profits back to the shareholders in the way of dividends. And so remember, as I in the previous slide, I was talking about flexibility. So that actually means there's actually less flexibility for this company moving forward, because what they've decided is to give most of the profits this company makes back to the shareholders in terms of dividends. So less flexibility for share buybacks, less flexibility for acquisitions and those sort of things. So always have to take a closer look at the profit, operating cash flow statements, and try to understand simple things like this. Now onto the valuation metrics for HiTech Group, looking at the P ratio, which is 18.2, price to sales ratio 1.27, and the price to operating cash flow 10.7. I'm going to ignore the price to operating cash flow and focus on the P ratio. The main reason behind that is because the operating cash flow for the year was 7.5, and I think that was a little bit too high and not really giving a true representation of the performance of this business over the past year. So that price to operating cash flow valuation is probably a little bit too low than what it should be. So let's have a look at the P ratio, 18.2. So what does that tell us about where the HiTech Group is undervalued or overvalued? And that is a fairly important question, because I want to buy HiTech Group if I'm interested in this company when it is undervalued. So you could take that 18.2 and look at similar companies in this industry, or what I do, I look at 18.2 and look at the historical ranges of the P ratio for this company over the past 10 years. And the P ratio for HiTech has ranged between 7 and 25. And remember, and that 7 was back in 2016, and that high of the P ratio of 25 was in the middle of 2021. And remember, the share price of this company has been increasing over the past 10 years, particularly from 2015 all the way through to the middle of 2021. So with the PE ratio increasing from 7 to 25, we know straight away there has been a period of multiple expansion for this company, which means the market is willing to pay more of a premium for this company over that time period. Now, since the middle of 2021, we have seen a PE ratio fall from 25 to 18.2, which is a period of multiple contraction. So now the market is less willing to pay a premium for this company. And we also know with the PE ratio of this company being below 10 for a period of time, back between about 2015 and we'll say about 2018, there is a possibility the PE ratio of this company could fall below 10 again, regardless of the financial expansion this company has been experiencing. So this company could grow their profit, grow the revenue over the next 2 years, but still the share price could fall from here because of multiple contractions. So at this point in time, looking at the P ratio of 18.2, looking at the historical ranges of the P ratio of this company over the past 10 years, I wouldn't consider HiTech Group right now to be really good value. And I probably would like a bit of a margin of safety for this company because I'm not, wouldn't consider this company to have a significant competitive advantage in their field. And one of the reasons I'd say that is because of the decreasing gross margins. When I do see decreasing gross margins, that is telling me there is a possibility the company doesn't have a competitive advantage or a moat. So I wouldn't be surprised to see the share price of this company pull back. But if we do see the share price or the P ratio of this company pull back to say 8 or maybe even 7, that would be the best case scenario. That is a sort of situation that I would become interested in this company. The other thing I did, and this is another way you could judge the valuation of a company and determine whether the company is cheap right now or expensive, is doing a reverse DCF. Now, with a reverse DCF, you might use free cash flow, possibly operating cash flow, but I actually use earnings per share for HiTech because I believe that is a better representation of the company right now. And reverse DCF is just telling you what the growth of the company has to be to justify the current valuation or the markup of the company, which is $80 million. And the earnings per share for HiTech only have to grow at 11% per year to justify that markup. And I don't think that's too high for this company. So when I did a reverse DCF, that is telling me there is possibly some value in this company. So when I do valuation or look at the valuation of a company, I look at all these different ways to do it. I do P ratio historical range. I do a reverse DCF. You might even do a normal DCF. Also look at the P ratio for companies in the sector and whether this company is higher or lower than that. So many different ways you could look at the valuation of HiTech Group right now. If I just focused on P ratio of 18.2, I might say there's probably not much value in this company right now. But if I did it, but focusing on the reverse DCF, I say this company could definitely grow their earnings per share 11% per year. And I'm comfortable buying this company right now at a markup of $18 million. Now onto the daily chart for HiTech Group, and this is their chart going back to late 2020, and the share price did reach a high in about, we'll say, August of 2021. That share price high was $2.44. It got very close to $2.44 back in early 2021, but the share price has been going sideways ever since then. So right now, the share price is not in an uptrend. It's not in a downtrend either. The other thing, of course, you have to take into account with HiTech Group is that the shares are illiquidly traded. Not a lot of shares are traded. In fact, the last day the shares were traded, the share price actually dropped from about $2.01 down to $1.90, I think on like 1 or 2 trades. So keep that in mind if you are interested in this company, that the shares are illiquidly traded and if you have to rush out and sell your shares for some reason, maybe you have to buy a yacht or something like that, don't be surprised if you have to sell your shares at a discount. And on the flip side, if you really want to rush in and buy a significant stake in this company, don't be surprised that you will have to buy the shares at a premium to what they are selling at right now. That's all I have for this video, looking at HiTech Group and their financial year 22 results. This company is a small company on the ASX with a markup of only $80 million. But revenue, profit, operating cash flow are all growing. That is a sign of a high quality company. So if they can continue to go down this trajectory, they have seen the company go down over the past, say, 7 or so years. And then the other thing I'd like to see this company do is start to grow, increase their gross margins. That is the main concerning thing I have in regards to this company, lowering or decreasing gross margins. If you have any questions, any thoughts, any concerns, if you disagree with me about their gross margins, you think it's okay, the gross margins have been dropping over the past 5 or 6 years, please leave your thoughts, your concerns, or questions in the comment sections of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.